the main reason the Japanese yen had weakened so much recently is just concern about the Japanese government's fiscal position. They're running a big deficit. They're spending more than they receive in income tax or tax in general. And that's been a concern for a long time in Japan. But we've got to lead up to an election in Japan on the 8th of February, and the respective parties are talking about cutting taxes, cutting consumption taxes, further stimulus. And so that's unnerved markets thinking, well, will the Japanese government be in a more difficult fiscal position after this election?
This is Converge,
a podcast from Canberra.
Come with us as we shape the future of finance.
Hello and welcome back to Converge Market Update, end of January the 28th, 2026. Hard to believe this first month of the year has flown by so quickly, and we're back with Steve and Dooley, head of market insights here at Canberra. Steve, good to have you. Obviously, some massive moves in FX markets this past week. Well, set the stage for us. What's been the trigger or triggers causing these shakeups?
Well, thanks again for having me back on again this year, Alex. And you're right, it's been a massive start to the year, but it always feels like there's lots going on in markets regardless. But certainly at the moment, that trigger was the big sell-off we saw in the US dollar Japanese yen pair at the end of last week, so on the 23rd of January. The reason why that move had been so significant is because the driver of the sell-off was that the Federal Reserve and the Bank of Japan both called leading trading houses to do what's called a rate check. The central bank calls banks and institutions and just says what rate is the market going for at the moment. And it's normally seen as the first step ahead of intervention of trying to force the market in the desired direction of the central bank. So to set the stage, previously the Japanese yen has been extremely weak. It's been a move of really 4 or 5 years, really since the middle of 2021, where the Japanese yen has just continued to weaken. That's been partly driven by, back then, the Federal Reserve raising interest rates and the Bank of Japan keeping interest rates on hold. That's been the defining story for the last 5 years. But even over the last year, as the Federal Reserve has started to cut rates and the Bank of Japan has started to lift rates, it still hasn't changed the trend. So it's been a very ingrained trend. Both the US and Japanese governments have warned about their concerns around there. But last Friday's rate check, as I said, is a sign that we might be looking at coordinated intervention. If that happens, it would be the first coordinated intervention with the Federal Reserve and Bank of Japan in 3 years. And before that, since 2011. So it's historic times in financial markets.
Yeah, sure sounds like it. So the next step is intervention. Do you think the Bank of Japan and the Federal Reserve start to sell US dollars and buy Japanese yen?
Well, yes. So that is the traditional next step, but we'll just have to wait to see how it progresses. Just because we see central banks performing a rate check doesn't necessarily mean that intervention is guaranteed. Sometimes that might be enough, and we've seen the dollar yen already move quite significantly lower over the last 4 or 5 days of trading. It's fallen from close to 160 down to 152. So, 4% move lower. But central banks have a number of different ways to influence floating exchange rates, like the US has, like Japan has. They'll typically start by what's called as jawboning. The central bank will come out and say, we're concerned about the rapid move lower in the Japanese yen. The next step might be the rate checks, which we said, which is basically a warning central banks getting on the phone to the brokers that are selling US dollars or buying Japanese yen and just warning them that they might be in the market. And then that final step is to intervene directly. So it doesn't necessarily mean that we will see intervention. Central banks might say, well, we've seen a move from close to 160 down to 152, taking some of the heat out of the market. That might be enough. So we'll wait for that story to develop. But that's what just causes markets to be on edge because no one knows what's coming next.
Yeah, ain't that the truth? So what's the outlook for USD and JPY and the US dollar if we do see that intervention?
Well, what's interesting is that intervention doesn't always work. And in fact, it's probably better to say that intervention rarely works. What's much more important in markets is the fundamentals. And so historically, central banks intervene in markets that might have a short-term impact, but over the long term, the fundamentals still tend to outweigh any moves from central banks. What's interesting, the yen is probably one of the most frequently intervened in currencies. The Bank of Japan is very interventionist, and we've seen a number of cases, probably 5 or 6 different periods of intervention since 1998. And historically, those previous episodes haven't really changed the broader trend. The Bank of Japan has stepped in. They might have moved the market for a period of time, but overall, the dominant trend has tended to resume. When we have seen a meaningful shift, it's usually been due to coordinated action. And so, again, that's why what we've seen over the last week has driven the headlines so much, is because this is unique. And historically, when we get a couple of central banks teaming up, that's when you can get a more significant move in these markets.
So the coordinated nature of any intervention has been the main topic of conversation this week. Many have sort of referenced the Plaza Accord from 1985. Can you quickly run us through that? What happened during that pivotal moment?
Well, let's just clarify this first of all, Alex. You and I only know about this from the history books. We weren't in the markets in 1985, so I just
You
want
got
to make
that
sure
right.
people.
I was 1 year old.
I want to make sure people know that. But it was an interesting period in the 1980s. The US dollar surged in the early 1980s, partly because Paul Volcker was trying to contain inflation by ramping up interest rates very, very high. Also, President Reagan had significantly increased defense spending. So the US dollar surged in the early part of the 1980s. And the Plaza Accord was an agreement of global finance ministers in 1985 to agree to coordinate intervention and push the US dollar lower. Now, the US dollar fell about 50% over the following 2 years. It had a huge impact, and it shows that coordinated action can have a significant impact on the market because it turned the US dollar from being one of the most overvalued currencies to being significantly undervalued. So again, that's why the headlines over the last week has been referencing the Plaza Accord, because that's another signal that coordinated intervention can impact. What's interesting though as well, of course, is that at that period the US dollar was very strong. It's a different story now. The US dollar's been really quite weak over the last 2 years.
Yeah, great historical context to learn from. So if you don't mind, why, Steve, is this all happening now?
Well, that is part of a broader theme that I think you will hear more and more of over the course of this year. But the main reason the Japanese yen had weakened so much recently is just concern about the Japanese government's fiscal position. They're running a big deficit. They're spending more than they receive in income tax or tax in general. And that's been a concern for a long time in Japan. But we've got to lead up to an election in Japan on the 8th of February, and the respective parties are talking about cutting taxes, cutting consumption taxes, further stimulus. And so that's unnerved markets thinking, well, will the Japanese government be in a more difficult fiscal position after this election? And it's something we've seen in other bond markets over the last couple of years. big sell-offs around concerns about government spending. And of course, government spending grew so much in the COVID era and post-COVID era that it is something that's more on the minds of bond markets. We saw the US had a big bond market sell-off after Liberation Day. We saw the UK had a big sell-off in their bond markets after last year's budget debates. Probably most famously was the big meltdown in UK bond markets after the Liz Truss budget in 2019. Last year, we also saw big sell-offs in France and the Netherlands as well in their bond markets as well. So rising fiscal pressure has been, on the back burner or a concern for markets, and it tends just to create these spot fires in financial markets. And again, that's what we saw over the last couple of weeks was concerns about the Japanese fiscal position. So I wouldn't be surprised if we see more of these kind of concerns into 2026. And of course, because foreign exchange markets are so driven by bond yields and interest rates, that has a big knock-on effect in FX markets. And of course, that's what we saw in the dollar yen, and that's what we've seen over the last week.
Very, very interesting. And of course, while all this happening, the US dollar has fallen with the US dollar index at 4-year lows as of today. Is that right?
That is right. And it's been a case that in the last hour before we recorded this, we heard President Trump come out to say that the falling dollar isn't a concern to him, that foreign exchange markets move around like yo-yos. And he said the quiet part out loud as well by saying, well, Japan and China look to devalue their currencies. So the implied position from that is, well, why shouldn't we? So the US dollar is certainly a key story out there.
Yeah. Very interesting. Well, Steve, this will be a fast-moving few months in the markets, and we'll have you back soon to break it down. Thanks again for joining us today.
Fantastic. Thanks for having me on, Alex.